Hi, Brian Chinappi. I'm a partner with Actis. I run the Asia real estate business, and we focus on the growth markets of Asia, which is Greater China, South Korea, India, and then some selected markets throughout Southeast Asia. Yeah, I think the current status of the Asia real estate market, probably the key theme would be continued resilience. We've seen kind of remarkable resilience in these markets really since the inception of COVID, I guess almost a year ago now. And many of our markets continue to be, the top performers globally from a resilience perspective, or even from, a fundamental GDP growth perspective. So we've seen that really continue through the entirety of COVID. I think sector-wise, similar to the West or the developed markets in certain aspects, where hotel and retail continue to be the most challenged. But hotel obviously from COVID, retail really it's just an exacerbation of trends, with e-commerce and change in consumption habits that were already well underway, as many have talked about. So I think those sectors are pretty similar. Office, though, very, very different. A lot of talk about the death of office in the U.S., or really a fundamental shift in the preferred office locations, maybe moving from large metropolitan areas to suburban locations. We don't have those issues in Asia. And so the office segment in Asia has been much more resilient. And we expect it to kind of come out of even this kind of shorter term kind of slowness much faster than you might see in the West. And we're not going to see these major dislocations. And then, the sectors that have been enhanced, that remains logistics, data centers, again, very similar to what we're seeing as well in Western economies. The trends that we follow, which really drive demand, we call them the secular demand trends in Asia, whether it's around demographic shifts, or it's digital disruption, or in some instances deficient supply in markets, and this concept of local institutional investors, seeking income-producing assets, and there being a shortage of those assets. All of those trends really have exacerbated as a result of COVID. Another trend that we've somewhat seen during COVID is first of all, we're seeing a lot of the larger Asian investors that have global real estate portfolios refocusing on home, and recognizing the value that's in their home markets. And then the second thing we're seeing now, I think it's really been more in the last 6 months, a real renewed interest from developed market investors to take a deeper look at Asia. Having been in Asia for almost 25 years now, I certainly have a home markets or regional markets bias. But we've always felt that Asia provides an attractive risk-adjusted return opportunity for investors, in addition to kind of that diversification that people look to for coming to Asia. But I think it's that risk-adjusted return is again even more resilient today. And so, with these trends being exacerbated, particularly the search for income, that desire, that search for yield, that's a trend that is global. But in Asia, I think one of the key benefits that Asia has is that, from a real estate perspective, we're very early days with real estate being used as an institutional investable asset class, at least in the growth markets of Asia. And we're also in the early days of local institutions kind of amassing capital. Whether it's, some of the sovereign wealths are more advanced, but pension funds, asset managers, insurance companies matching liabilities with local assets. And so there's this huge need for long-term income-producing assets, and we're really just at the cusp of that. And that's a huge driver in Asia. Probably, to me, it's probably the biggest support for the investment case out here. To be able to take advantage of these opportunities, we found that being on the ground remains critical. Working with high quality local operating partners remains critical. This is an interesting area because on one hand, the major markets in Asia have been leaders in terms of public health policy, keeping infections down, keeping healthcare systems very sound. But on the flip side, been slower on the vaccines. And I think part of that is because there's been less of a push by governments to control local infection. Certainly now, where we sit today, whether it's the UK or the US, for example, much further advanced in vaccine adoption. So I do think, over the next 6-9 months, that will play out a little bit differently. It may actually hurt some near-term growth in Asia that depends on international travel. So I think it's a space that people need to watch. But again, if you're focused on asset classes where it's the domestic economy driving the demand, we think the impact is going to be quite muted. And the other thing final thing I would say is that we probably will be surprised by how quickly some of the Asian markets catch up. So when they get their act together, decide that vaccines are now required, just the way some of our governments work, let's just say, in these markets, the ability to put these vaccine rollouts in place and to, encourage the jabs into the arms will probably surprise us on the upside. I think probably the key standout, over the next probably 24 months for investing in Asia is that you can follow these fundamental trends and be confident that they're in place. You don't have to take as many views on timing as to what COVID may do to disrupt either asset classes or locations. And I think that's actually quite different from more developed markets, where there may be very much, in some ways, lower hanging fruit from a higher level of dislocation. But that also will require taking perhaps a stronger view on what locations will be winners and losers, what specific assets will be winners and losers. And so in that sense, while there may be, on paper, a better valuation point on certain assets, there's probably a bigger decision the investor will need to make on those structural shifts. And from a COVID perspective in Asia, we don't see those massive structural shifts. We really just see a continuation of shifts that have already been in place. And so from an entry perspective, it's perhaps a less risky point of entry.